Today we look at 8 reasons why you should refinance. Okay, so the first reason you should look to refinance is if you're looking to use your equity to fund a renovation or extend your property. This is very normal, and there's a couple things you should know if you're looking to do this. Firstly, when you're renovating, you can actually use the equity from the renovation to fund the construction. Let's take a look at how this works. Let's say your home is worth $500,000 and you've got a loan of, let's call it $400,000. So what you're looking to do is you're looking to renovate and you're looking to spend $100,000 on the renovation. You've owned your home for a little while now, and what you're looking to do is you're looking to incorporate the construction loan in your existing loan. Essentially, what you're looking to do is you're increasing your loan amount to $500,000 and you're looking to fund the full renovation through a construction loan. Now, if you're looking at a high level, you can see that right now the loan amount will equal the current valuation. And if you're looking to construct, you might say, hey, look, this is not possible. However, there's a caveat. The bank will consider the $100,000 you're looking to spend here and will look at what's called an as-if complete valuation. Essentially, what is the property worth once you've completed the renovation? I did a video recently where someone completed an $8,000 renovation and it increased the sale price by $300,000. And in this market, if you complete the right renovations, doing the right things, you'll be surprised how much you can increase the value of your property. For the sake of simplicity, let's just say that once you've completed the renovation, that your home is indeed worth more. And in this case, we'll go to $500,000 plus the $100,000 renovation. So we've got now a $600,000 property over a $500,000 loan. Loan to value ratio will equal about 84%. So yes, mortgage insurance is applicable, but the beautiful thing here is that you can support the full construction facility through the loan with the increased equity based on the completion of the renovation. And that's one reason why you might look to refinance. Now, the next reason you might look to refinance is to leverage the equity to purchase another property. Whether it's to be an investment property or to live in, both are the same concept. So let's take a look at how that works. Like before, what the banks will look at is they'll look at your current property and the value. So in this case, we've got a $500,000 property and a $400,000 loan. And in this example is your original loan setup. So you had purchased a property for $500,000 and you had taken a $400,000 loan out. Let's fast forward and we look at today. Now you've revalued your property and your property's worth now $700,000 and you've managed to pay off your home loan to $350,000. What we can do off the bat is we can bring this loan back up to 80% without incurring mortgage insurance. On a valuation of $700,000, we would be able to support a loan amount of $560,000 based on an 80% loan to value ratio. This would mean that you potentially could leverage about $210,000 in equity to purchase the next property. So we understand how equity works. Now let's look at how you would facilitate a purchase. Let's say that you're looking to buy an investment property for $400,000. This is how we would look to structure it. So firstly, we would never cross-secure the properties. Cross-securing would essentially mean that when you look to sell a property, you'd have to value both properties in order to sell. And we'll look at why that's a problem in a moment. But sticking with this scenario, we would first structure this at 80% loan to value ratio. So based on that, we'd have a $320,000 loan and we'd need another $80,000 worth of costs for the deposit, plus let's call it $20,000 in stamp duty and other fees. Now we know we need about $100,000 to complete the purchase. How we would structure this is that then we take that $100,000 from your existing property. So we'd have a $100,000 loan, and that's the investment loan, and we'd also have your $350,000 existing loan. That's your principal place of residence. This would be all secured over the $700,000 property we had earlier, remembering that we can go up to $210,000 on this new facility without exceeding the 80% loan to value ratio. The investment loan would be on investment rates and the principal place of residence or the property you're living in would be on owner occupied rates. So the two facilities would be completely standalone. This would mean that if you were ever to sell this investment property, that there would be no revaluation needed on your principal place of residence. If the valuation had decreased, and this is a problem with a cross-secured loan, then the bank might take more. So by having it stand alone, you essentially know exactly what will happen when you sell your investment property. So long as you pay out the debt, the remaining funds are yours. So it's very important, if you are looking to do this structure, that you always set it up as what's called a standalone application and avoid cross-securitization at all costs. Now, the next reason you might look to refinance is to release equity. Oftentimes, as your value increases, if you release it and hold it in an offset account or redraw, it allows you to use that funds when the market might turn, so you can take advantage of when properties drop in value. Having released the equity, you will have locked in the money so that you can use it. So even if your property decreases in value, you'll be able to take advantage of the market when it changes. The fourth reason you might look to refinance is to pay down debt. And this is a great way to reduce your overall payments with your total debt structure. So if you've got car loans or credit cards, you might find that by consolidating it in a home loan, you'll in fact reduce your total repayments on all debt facilities considerably. One thing you want to keep in mind that if you do this, you'll want to keep that debt consolidation loan separate and ideally on a shorter term. Most cases, home loans in Australia are put on a 30-year term. The problem here is that you'll be paying those facilities, which are usually paid off within a 5 or 7 year period. You'll be extending the term over a 30-year period. So whilst it will reduce your payments, it'll increase the total interest you'll pay over the extended period of time. So you want to get that balance right, of where you'll reduce your payments because of the term extending and the interest rate extending, because in most cases, personal loans will be upwards of 14% versus your home loan of under 3%. The thing you want to be careful of is making sure that balance is right. The next reason is that you'll want to switch your loan to a more suitable one. So if you currently are on a basic home loan with no offset, maybe you look to refinance so you can get a facility with an offset facility. Or if you're on a variable rate and wanting to switch over to a fixed rate, another great reason to be looking to refinance. Some of the things to keep in mind if you are looking to go on a fixed rate, there are limitations on the amount of money you can put into the facility. Most cases, it's between $10,000 to $20,000 in additional repayments on the minimum. So if you are looking for a fixed rate, you might consider having a portion fixed and a portion variable. And if you're looking for an offset facility, be careful of the lenders. Not all lenders offer unlimited offset facilities. Some lenders will limit you with one offset account per loan split. So few things to keep in mind if you are looking to switch your home loan for those reasons. Refinancing for a lower rate. And this is a big reason why a lot of people look to refinance. But before doing anything, first reach out to your bank to see whether or not they can sharpen your rate. You'll be surprised what lenders are doing at the moment. They haven't given you an offer that you're comfortable with. The next thing you can do is search the market. The best way to do this is through mortgage brokers. Most mortgage brokers don't charge a fee and have an array of lenders on their panel. And what a great mortgage broker will do is they'll compare the costs of you switching your home loan compared to staying with your current provider, making sure that there's a benefit to switching and that you're not just refinancing for the sake of refinancing, because if you are looking to switch for a lower rate, you want to make sure it makes financial sense. The next reason is if you're looking to reduce your payments on your home loan. So this is a very common one. So let's say you've had your home loan for 10 years and you've only got 20 years left on your home loan repayments. Many will refinance their facility and extend it over a 30-year term. That'll decrease your payments significantly. Let's take a look at a live example. So this example, we can see that you've got a home loan of $500,000 and the term is 20 years. The repayments on this is $761 per week. If we were to extend that, we would go from $761 to $619. So you can see there's quite a large savings there, and all we've done is not even change the interest rate, but change the term. The things you want to be careful of if you are looking to do this is that you will extend the term and as a result will pay more interest over the lifetime of the loan. But in the short term, it can be a great way to free up some cash flow. Well, there you have it. There are all the reasons why you should refinance. And if you're looking for a great mortgage broker here at Hunter Galloway, we can help. We help Australia-wide and we don't charge a fee for our service. So you're looking for a mortgage broker, reach out and hit us up at huntergalloway.com.au or call us on 1300 088 065. And until next time, thanks for watching.